All right, let's dive straight into the numbers, shall we? Today, we are opening up Jio Platforms' Draft Red Herring Prospectus, or DRHP, to figure out exactly how this massive digital ecosystem turns raw connectivity into, well, gold hard cash. We're going to strictly use their disclosed data to break down this financial engine from top to bottom.
Now, take a look at this number, 1,468,853 million rupees. That's a lot of millions. That is Jio's reported top-line revenue for fiscal year 2026. Hitting this kind of scale just 10 years after their launch in 2016, it's honestly staggering. But, as you'll see, top-line growth is just chapter 1 of this story.
So, what's the central question here? How does a massive user base actually turn into sustainable profit? We're going to answer this by walking step-by-step down Jio's financial funnel, separating the pure DRHP facts from the analytical interpretation.
Here is our roadmap. We'll start with the top-line engine, look at operating profit and leverage, check out the cost structure, weigh the price of infrastructure, build the profit bridge, and finally, wrap up with the 3-year scorecard. No dense accounting jargon today, just the mechanics.
Okay, Section 1. The top-line engine, the revenue trajectory.
Starting right at the top of the funnel, revenue from operations shows a clear, super aggressive upward trajectory. We're going from roughly 1.09 trillion rupees in FY24, stepping up to 1.28 trillion in FY25, and then boom, hitting nearly 1.47 trillion by FY26. That is just consistent, year-on-year growth driven by their multi-layered architecture.
But where is all this money actually coming from? Well, the DRHP puts the revenue mix into 2 broad buckets. You'll see that value of services, which is their digital and connectivity portfolio, brings in over 1.69 trillion rupees gross. Value of sales is just a tiny fraction at under 32 billion. So once you deduct recovered taxes like GST, you get to that core net revenue. It's pretty clear. Digital services are the undisputed driver here.
Moving on to Section 2, operating profit and leverage, squeezing the funnel.
Now, as we move down the funnel, we need to see how much of that massive top line actually survives as operating profit, or EBITDA. It goes from about 549 billion rupees in FY24, climbing all the way up to nearly 763 billion in FY26. So the business isn't just generating more sales, right? It's consistently keeping more of that cash at the operating level.
And check out this percentage, 51.91%. That's the EBITDA margin for FY26. Literally, for every single rupee of revenue Jio brings in, more than half is kept as operating profit. Maintaining a margin above 50% for 3 years straight, that points to a seriously cost-efficient, vertically integrated structure.
So, the big question, is Jio growing profit faster than revenue? Absolutely. When we put these two growth rates side by side, we see a revenue compound annual growth rate of 15.79%, going up against an EBITDA CAGR of 17.79%. This right here is solid evidence of operating leverage. It's the ultimate financial hero. It basically means their core costs aren't growing as fast as their revenue, making every new customer even more profitable than the last.
Section 3, the cost structure, where the money goes.
To really get what's behind that margin, we've got to look at what specifically is eating into the remaining 48% of the revenue. The DRHP breaks down the major operational expenses for FY26 like this. Running the actual physical network costs nearly 345 billion rupees. Then, government spectrum charges and license fees take another 117 billion, employee benefits sit at about 66 billion. So managing that massive physical network is by far their heaviest operational burden.
All right, Section 4. The price of infrastructure, tech and telecom waits.
Now, operating costs only tell part of the story here, because tech and telecom are incredibly capital-intensive games. EBITDA is not the final word on profitability. These networks require massive upfront investments, and those assets lose value over time. That reality is accounted for through depreciation and amortization, or D&A.
Look at this. In FY26, Jio recorded a massive D&A expense of over 272 billion rupees. That vividly illustrates the sheer cost of keeping up such a vast footprint. I mean, you have to constantly refresh servers, update towers, and account for the ticking clock on those super expensive spectrum licenses.
And we have to add in the disclosed finance costs, which are the interest expenses on their borrowings and leases.
Notice how this is literally more than doubled, jumping from about $40 billion in FY24 to over $86 billion in FY26. Building a digital empire requires serious capital, and as we all know, capital definitely isn't free.
Let's bring this to Section 5, the profit bridge, connecting top to bottom. This bridge shows the exact sequential journey of a rupee through Jio. You start with the billions earned in revenue, systematically squeeze that down by subtracting operating costs to get EBITDA, which acts as the baseline for your operating cash flow. Then, you deduct the heavy capital realities of Capex, D&A, and finance costs. And finally, you take out the taxes to arrive at the true bottom line, profit after tax.
Ultimately, the funnel narrows down to this, the profit after tax. Just look at that FY26 number. It proudly crossed the 300 billion rupee mark, landing at a really robust PAT margin of 20.46%. This proves that even with the massive weight of network costs, amortization, and interest, the underlying business is generating serious, tangible profit.
Finally, Section 6, the 3-year scorecard, one investors must watch.
You know, one of the most fascinating metrics disclosed in the DRHP is the net leverage, which is basically their net debt divided by EBITDA. Look at this aggressive drop. It falls from 0.88 times in FY24 to just 0.36 times in FY26. What that tells us is that their strong operating cash generation is effectively shrinking the company's relative debt burden over time. This dashboard right here represents the pure facts straight from the DRHP. Top-line revenue growing steadily. EBITDA growing even faster thanks to that operating leverage we talked about. The bottom line PAT is robust, scaling beyond 300 billion, and the debt leverage is shrinking. It just shows a highly efficient engine that's translating sheer scale into both profitability and sustainable cash generation.
So, evaluating this business means looking past the hype of pure customer numbers and focusing directly on the mechanics of the funnel we just walked through. Can they maintain these incredible margins as they scale into new technologies, or will the weight of future infrastructure upgrades eventually narrow the funnel? Because ultimately, the important question is not simply how fast Jio is growing, it is how efficiently that growth converts into sustainable profits and cash,